Imagine you buy a stock at $100. A few months later, it drops to 70, then 50. Now you have a decision to make. You can sell and accept that you were wrong, or you can hold it and wait for it to come back. Most people assume that smart investors would know exactly what to do. But here's the uncomfortable truth. Being intelligent does not automatically protect you from making bad investment decisions. In fact, smart people can sometimes be better at convincing themselves to keep a losing investment, and the longer they hold it, the harder it becomes to let go. So why does this happen? The answer has less to do with finance and more to do with how your brain handles being wrong. The first trap is simple. You tell yourself, I'll sell when I break even. Let's say you invested $10,000 and now it's worth only $5,000. You might think, I'm not selling until I get my money back. But financially, this logic has a serious problem. The market does not know the price you paid. Your purchase price has absolutely no influence on whether the investment will recover. Yet psychologically, your brain treats that original price like an important target. You become attached to the number you originally paid. So instead of asking, if I had this $5,000 in cash today, would I buy this investment again? You ask, when will I get my money back? And those are two completely different questions. Then comes the second trap. The more time, effort, and research you put into an investment, the harder it becomes to walk away. Imagine spending years researching a company. You read the reports, watch interviews, follow every quarterly update, and defend the investment when other people criticize it. Then the investment starts collapsing. Selling now does not just mean losing money. It can feel like admitting that you were wrong, and for many smart people, that can be surprisingly difficult. When you are used to believing that your decisions are rational, being wrong can feel like a threat to your identity. So, instead of objectively re-evaluating the investment, you may start searching for information that supports what you already believe. Good news becomes proof that you were right, bad news becomes temporary noise. At that point, you are no longer analyzing the investment, you are defending your previous decision. And this is where intelligence can actually become dangerous. A smart person may be able to create a more convincing and sophisticated explanation for why they should continue holding a bad investment. They can explain away warning signs, find supporting data, and build complicated arguments for why the market is wrong. But intelligence does not eliminate bias. Sometimes it simply gives bias better arguments. Then comes one of the most expensive thoughts in investing. I've already lost too much to sell now. Think about what that really means. You are not necessarily holding because the future looks attractive. You may be holding because the past hurts. But the money you have already lost is gone whether you sell today or continue holding. The only question that matters is what gives your remaining money the best opportunity from this point forward. Imagine buying an expensive product that turns out to be terrible. You already spent the money. Continuing to use it for years does not magically recover what you paid. The same principle applies to investments. The fact that you lost money does not automatically make holding the investment the best decision. Your previous loss should not determine your next decision. But emotionally, that is exactly what often happens. The real reason smart people keep holding losing investments is often emotional, not logical. Selling creates a certain and immediate pain. Holding creates the possibility of avoiding that pain. Maybe the investment will recover, maybe your original prediction will eventually be proven right. Maybe you will not have to admit that you made a mistake. So, your brain chooses hope. Not necessarily because hope is the most rational strategy, but because accepting a loss feels painful right now. And that's the trap. You avoid short-term emotional pain while potentially increasing your long-term financial risk. The investment may recover or it may continue falling, but refusing to examine the decision objectively simply because you do not want to realize a loss is not a strategy, it's avoidance. So, instead of asking, should I sell because I'm losing money, ask yourself a better set of questions. First, if I did not already own this investment, would I buy it today at its current price? Second, has the original reason I invested actually changed? And third, am I holding because the investment still makes sense, or am I holding because I don't want to admit that I was wrong? That last question is uncomfortable, and that's exactly why it matters. Investing is not about proving that every decision you make is correct. Nobody gets every decision right. The goal is to make the best decision based on the information available to you right now. When the facts change, sometimes your decision should change too. Sometimes holding a losing investment is the right decision. Sometimes selling is the right decision. But neither choice should be based purely on protecting your ego, chasing your original purchase price, or refusing to accept a mistake. The smartest investors are not the people who are never wrong. Those people don't exist. The real advantage comes from recognizing when your original decision no longer makes sense and having the discipline to update your thinking. The market does not reward you for being loyal to a bad investment, and it definitely does not care how much money you originally paid. So, the next time one of your investments is deep in the red, stop asking when will I get my money back. Instead, ask yourself, knowing what I know today, would I still choose this investment? The answer might be uncomfortable, but facing that discomfort could prevent one bad decision from becoming a much bigger mistake.